Hey, how are you doing? I just wanted to make a video in hopes that more people could see uh, Kite's strategy. Um, I've seen that there's a lot of scammers out there making videos on ways you can make money through the markets and ways of trading. And I'd say 99% of them are scams that don't work, and they're just trying to sell you a course or use their software or whatever it is. Uh, and I can't recommend you guys check out Kite Crypto's channel enough. I've been trading for 2 years. I am now 18, so take anything I say with a grain of salt. I'm still learning, I'm still young, but I've been trading for 2 years since I was 16. Uh, I tried, I followed multiple YouTubers, I followed multiple strategies, none to any avail other than Kites. I will admit Trader's Reality as well. He has points that I find have worked, but a lot of it's on vibes. Whereas what I like about Kite's strategy is that exact rules that you can follow, so there's no confusion, and you can keep your emotions out of it. There's clear reasons to enter a trade and clear reasons to exit. So Kite has been trading for 3 or 4 years now, I believe. Traditionally, he used to trade. Uh, well, when I saw him going big, he was trading a lot of Elliott Wave, but I believe he realized that there was a lot of problems with Elliott Wave. There's um, there's a lot of laws in Elliott Wave that don't apply in the modern market, or if you take too religiously, you'll miss out on trades or miss out on opportunities. So he developed a strategy. I'm not sure if it was completely his or if he implemented other people's strategies, but the way I learned it from was him. So I will say that it is his strategy. Is the ABC strategy. It is similar to Elliott Wave, but simplified again. So there's less rules and less things you have to worry about. If I could understand this at 17, I'm sure you could understand this because I'm not special. And there are a lot more people, a lot more intelligent than me. And I'm sure there's ways you can make this more advanced and more helpful if you want to. Like I have added bits and I will show that in the future. But right now I'm just going to go over the basic premise of my understanding of Kite's Elliott Wave. Not Elliott Wave, ABC strategy, sorry. So the premise of this strategy is entering based on three trends, either long or short, and using maths and an exact stop loss to mathematically over time uh, have an edge on winning. That is basically what all trading is. It's just maths and risk, and you're trying to have risk on your side. Uh, the way he the way he has his strategy is very simple. You don't use any indicators other than maybe like you could call Fibonacci an indicator, but there is no there's not necessarily indicators you have to use. It is just simple market structure, and you follow it. So, for example, you have a rise, a retrace, and a rise again, making three trends. A, the initial rise, the retrace, B, and another rise, C. What you're going to enter on, based on his strategy, is after we come above the A, the initial rise, and we retrace, you're going to make a line on the high uh, to right at the top. And if we come above that high again with a C wave or a second initial rise, we will put in a short position for when the market comes down below the A again. So the way Kite trades traditionally, I believe, is he would only trade if there is a at least a 10-to-1 ratio. And from what I can see, he trades using 1% risk. So in this case, we would have if the market came up to say 32 grand, and then we came back down to where our initial line is at 27,500, we would put in a short with 1% risk in hopes that we would be making money off from here. Basically, after we come down the A wave, we would be entering short. Uh, I'm sure you can see that there would be a problem. What if we're coming up and down, up and down, up and down, up and down, and we keep getting stopped out? Yes, this is not a foolproof uh, strategy, you are going to get stopped out. What you have to do is you have to enter every time. You have to set up a conditional order to go short again every time you get stopped out, every time you get stopped out, because it's no strategy is foolproof. No strategy is going to make you money 100% of the time. This what you'd be hoping for is that this goes straight down and you get a perfect trade and you come down, you hit your target straight away. But realistically, we're going to come down. Maybe you might be in profit. You come out, you get stopped. Come down, you get in profit, you get stopped. Might come up, and it might make it even higher. You might have to make another. Uh, you might have to make another trade from here, and you might be going short from here now. If we come down, up, down again. Sure, this is all a mess and very confusing, so I'm going to use some real life examples. But this is the initial structure of how you trade. You make a short off of the A line, or vice versa. You make a long based on the A line. You come down, up, down, make it long on the A line, and you come up. That is the trading structure. So real life examples coming from here, we have an A line comes up, that's one trend. Trend breaks, we come down, form a low, we come up again to form the C, come above the A. We make a short on the A line, and we coming down, we come up, we got stopped, come down, get stopped, down, 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 and you'd make an amazing trade off that. For example, here, if we had 1% risk, probably would have stopped out 5, 6 times there. But the potential of this trade, it went much further down. But if the way you can base your target on anything you want. You could base it on if you're using third-party sources to see where there's a lot of liquidity, or you could use Fibonacci like this, like I've set up here. The way the trade is set up here is have the fib come from the low to the, or come from the top structure to the bottom of the structure that you're measuring. Measure down, and you had this was your target around this area here. You could have had your 1% loss. That would have 1% stop loss. You would have stopped out 5 times, came down, and you would have made 45 to 48% if you followed it all the way down. This is at a high structure, so you wouldn't necessarily have, like, you might have even taken profits up here. You still would be 32% for the 1% loss. That is still a 33 to 1 win to loss ratio. So the whole dynamic, or the whole process of this strategy, is to try create trades that are favorable in your direction in terms of risk to reward. And like, I personally don't trade anything unless I can make 12 or 15 to 1 odds. That's how I've been able to make this profitable. I think if you go down to 5 to 1 odds, you're going to get stopped out too much. Even 10 to 1's a bit iffy. But then you don't want to go too high, because then you might never reach your target. Like, you don't want to be doing 1 to 100. Otherwise, you might not make any trades, or you're not going to be able to grow your account. So it's about finding that middle ground. Like, I find 1 to 12 to 1 to 30 a good spot for day trading, week trading. Like, I'll keep trades for a few days, a few weeks. I don't like trading for a few weeks, honestly. I like to have trades be over in a few days, maybe sometimes a day or two. It depends on how fast the market moves. Like, if you like this here, we have an ABC structure with A, B, C. If you traded off the bottom here and you just wanted to, if your measure was that you wanted to hit, let's say 0.441 as a retrace. Let's see what your odds would have been here. What a simple trade this could have been. stupid thing. 15 to 1. And that would have taken you how many days? Would have taken you a week if you went all the way for the retracement that you were wanting. You would have got 15 to 1 odds, plus I don't think you would have got stopped out at all. So you would have got into your trade straight away, 15 to 1 bang on within a week, 50% gain at 5x leverage. What's that like? Sorry. 75%, 80%, like around there. Sorry, I'm probably butchered the maths. But 80% added just from a week of trading. Like that's over time, it compounds and can work out really well. So yeah, I hope I'm sure I'm being confusing. This is probably a bad first video, but I do recommend you guys check out Kite Crypto's channel. He explained this much better than me. I'll try to explain this better in the future, and I will be streaming my own versions of similar to him soon. But I hope I made sense in how you trade this. I'll probably remake this in the future more clear. But to go over it one more time, you're gonna be going over 3 trends, and you're gonna be trading against the direction that we just gone. So A, B, C, come down from the A, and you're hoping to come down. You can trade the way Kite trades Fibonacci's. You can either trade retracements or you can trade hoping for the next leg. Let me get rid of all the drawings. For example, here, if we had an A, B, C, the 2 trades you could have stacked against each other here were, if you're trading this ABC here, oh, like you see, you can have 2 trades against each other. This is the good thing about this strategy as well. Sorry. You could have 2 trades trading against each other. I could trade this here, this ABC, hoping that we get up to 53K. This is a long position. 46. About 45 to 1 odds. And that wouldn't have been hit. I wouldn't have made this trade. But if for the same reason you went off this here A, you traded down from this structure here, whoops, we would have had the opposite. About 31 to 1 ratio. So see, it's not going to work out every time, but you can put yourself in positions that are safe and good, and you're able to have concrete ideas that are going to stop confusion as to where you think price is going to go. You can set up trades in both directions, and if you're wrong in one, who cares? You're probably going to be right in the other. And it's just about setting up these ABCs that put you in safe positions so that you know exactly where you're going to enter, you know exactly where you're going to leave. That's all this is. It's about trying to have yourself in a safe position so that when the market moves, you can trade at a safe place, know where you're going to get leave and where you're going to enter. Like you would have got stopped out on this long here on the ABC up, but because you entered in down here, you're still going to be making all the money on this trade here, as well as you're going to be looking for trades on the way down. You're going to have ABCs here. Probably took this trade here, didn't work out. Who cares? You probably got stopped out 5, 6, 7, 8 times here. Didn't work out. Who cares? Trade went down again. Even here, even if you took profits here, look, we have another ABC down here that you could have set up another short from. A, B, C. Shorter this thing down. You could have got most of this trade here. Sure, you lost out on some profit, but are you really gonna be mad? Are you really gonna be mad? I don't know. I just think it's a simple and effective way to trade. Sorry if this is a confusing video. I might try to remake it. But if you've made it this far, please check out Kite Crypto. He explained this much better than me, and he does a much better job uh, of predicting the market and understanding the market than me. Uh, this is the reason I made this video is in hopes that more people see his strategy because it truly does work and it truly is a way to be profitable over a long time. You know what I mean? Like I said, it's not foolproof. It's not going to work every time. No strategy does. It's a way to help you make money over a long time as long as you use the right risk. Thing I haven't gone over this video is risk. And I'm not even sure if I'm qualified enough to talk about it properly, but as Kite would say, you should be risking maybe 1%, 0.5% of your account. I think even says 1% is high. Depends how big your account is, honestly. You should be trading about 0.5 to 1. You should be risking 0.5 to 1% of your account every trade if you're trading like this, even less depending on the size of your account. I personally risk 1%. That's just me because I don't have a massive account yet. It's still growing. So at 1%, I'm risking a good bit of my account every trade, but it's in the hopes that I make it's the hopes that I might add 10% to my account every time I trade, or 15, 20%. You know what I mean? So even if I lose, even if I get stopped out 5, 6, 7 times in a trade, my odds are 12 to 1. Hopefully, I'm going to make 6, 7% of the account in the end. If the maths keep in my favor, I keep doing the right thing. You should not be using 3% risk. You should not be using 2.5, 5%. Anything like that's ridiculous, guys. If you lose 6 times, you're going to lose 30% of your account, 50% of your account. Like this isn't going to work every time. No trade works every time. It's just a way to. It's just a way to help, but not completely predict the market. I wouldn't even say it's a way to predict the market. It's just a way to get involved in the market and ride the waves. That's all it is. You're just riding the waves up and down, hoping that you can reach the right targets and cash out. Yeah. So like again, definitely check out his YouTube. It's much clearer than me. I hope this made sense, and that I hope this helps somebody, or at least somebody understands. And have a nice day, guys.